Good morning, everyone. Welcome to our webinar today. We are going to give it another few seconds and then probably about 30 seconds more just to allow a few more people to come on. For all of you that are joining us from around the world, whether it's somewhere in Africa or in Mauritius, etc., thank you for joining us. And we're really excited with reference to what we're going to be talking about today in reference to sort of unpacking the details around how to mortgage your property in a buy-to-let scenario. So just give us a few more seconds and then we'll kick off. Look forward to going through today. Okay, I think let's just carry on. So from our side, we're going to just really talk through today about finding a solution that really best suits your needs with reference to any questions you have around mortgages with specific reference to in the UK. And I'm really excited today to also, besides having Craig from SevenCapital, who you may be familiar with, who's one of our development partners. Welcome, Craig.
Very much, Scott.
And from the other side of, on the UK side, we've got Lauren Miller and Craig Stephen, who are from Visionary Finance. Welcome, Craig and Lauren.
Thank you.
Great. Okay, so just in terms of what's on the agenda today, it will be sort of really a short agenda, but in terms of quite a lot of unpacking of detail within those areas. So we'll just do our usual aspect in terms of just why some of the key components investing into international property, and then we're going to go with Visionary Finance. They're just going to tell us a little bit about themselves and then the mortgage process. And then what we've done is we've got the panel here today just to talk about some frequently asked questions that come across that we come across certainly in our area that we get from locals and from Africans as well, along with what the UK in terms of Visionary Finance, Lauren and Craig often come about. And then Craig Warwick from SevenCapital will also take us through some of within that process, some of the price ranges and what you can get for your money in the different jurisdictions within the UK. So going into the reasons to invest into international property, some of these might be obvious and they might be familiar with to most of you, but just to remind you of why we do this in terms of externalizing your local currency into other jurisdictions. With reference to the normal kind of investments offshore, it will be looking at markets that have sort of an economic and political stability as opposed to the volatility of your local market or economic climate. It's also looking at the currency exposure in terms of, in South Africa's case, for example, externalizing your rands into pounds or dollars, and then obviously providing a diversification into your portfolio and long-term wealth generation. With specific reference to property, which is a slight differentiator to some of the others, it's a more tangible, stable asset class. So in some cases, it might, where you can sort of, if the markets are dipping, etc., you might sell your stocks or etc. a little bit quicker, whereas property makes you, almost forces you to be a little bit more stable in your thought process and not be reactionary, and therefore providing a more tangible, stable asset class where there's less volatility in the marketplace. And then for the key one, in terms of our savvy investors who are building portfolios, is really looking at the leveraging options available to you and the low cost of finance, especially in the markets like the UK, versus your local prime rate as well. So when we're moving on and looking at international property, these are some of the key aspects for it. And obviously they might, for whatever your objectives are when you're talking to a property consultant within Carrick or a wealth manager, is to understand what your objectives are and where you'd like to go. So moving on to Visionary Finance, we're excited to have Craig and Lauren. And they are really sort of experts within the UK market in terms of mortgages. And I'm going to, as I've already introduced Craig and Lauren, I'm going to pass you on to Craig. And Craig's going to tell us a little bit about Visionary Finance along with the fact around the mortgage process. And then we'll go into the Q&A. So welcome, Craig and Lauren.
Thank you very much for the introduction, Scott. So obviously, as mentioned by Scott, we are the recommended mortgage brokers to SevenCapital, worked alongside them for many years now, and we are, as mentioned, the independent whole of market mortgage advisors. So we are regulated by the FCA as well, and the whole of market is rather important for our clients in particular. It essentially means we have access to all of the international lenders in the market, which means we're able to provide you with the cheapest rates available to yourself. Again, we've been dealing with SevenCapital since around July 2018, and since then we've assisted over 400 borrowers internationally as well as locally with their financing requirements. We pride ourselves on our extensive knowledge of UK new build in particular, as well as just the general buy-to-let market, and we have facilitated over £500 million worth of UK mortgages since 2015. We offer bespoke advice tailored to our individual clients. We always make sure that the advice we provide is directed to our clients directly, and we have, as mentioned, access to over a dozen different specialist lenders, which means that we're able to compare the rates from all of the international lenders, able to tailor them to yourselves. And our main sort of focus is the fact that we are a firm sort of driven based on our customer service, and we try to provide the best service possible to our clients. Next slide, please. In terms of our process, we like to make it as simple as possible. We often find that the mortgage market, or the mortgage application process, can be made a lot more complicated than it needs to be, especially for the likes of clients that are based internationally. If you're trying to apply for a mortgage based abroad when investing in the UK, especially in the likes of South Africa, Nigeria, and all of the other African nations in particular, it can be a lot more difficult. So what we try to do is simplify the process as much as possible. So there's just a few steps which we run through, and hopefully limiting the amount of work which you need to do from your side and taking the workload on by ourselves. So initially what we'll do is we'll have a consultation with yourselves. That will allow us to gather a bit of an understanding about your personal circumstances, as well as your mortgage requirements in the UK and your intentions for the property. Following our conversation, we'll be able to give you an idea in terms of indicative rates. That will come from the discussion we've got, because that will allow us to narrow down the options just based on the brief discussion which we've had. And on top of the rates, we'll give you an idea in terms of the process, as well as the loan to values that are available based on the circumstances. Following our conversation, we will then send out the list of required documentation which we need from yourself. It's then your job to work on getting that back to us as and when you get an opportunity. Obviously, the sooner the better, the sooner we can look into the options. That is essentially your job done. It's then over to us again just to do the research, make sure that we're checking every international lender, and then once we have presented you with the best rates available to yourself, we will then, and once we've got your confirmation that you're happy with the rates, I say they will always be the cheapest available to you. We submit the full mortgage application and help you there every step of the way through the underwriting process and the valuation process until we get you to offer. The average timescale for an international mortgage application tends to be around sort of 6 to 12 weeks. 12 weeks being the sort of worst case scenario, but that all depends on the particular lender and the complexity of the case. But we'll always do what we can to ensure we get it through as swift as possible for you.
Okay. Thanks, that's great. I think, from our perspective, just for those of you that are on this webinar, there will potentially be a little bit of overlap in some of the questions and answers in terms of, obviously, from just a natural, the way things are done. I think from our perspective, what we often find is that when the mortgage requirements, as an example, in that process are taking a bit longer, unfortunately, it can be that the paperwork coming back from the client is a little slower, and that also can drag out the process as well. So, in the perfect world, it probably could be 6 weeks if we get all the documentation and everything in place. And part of this webinar today is obviously, from our perspective, is to also just discuss what things you can do to get ready. And obviously, from our side, is us putting you in touch with the likes of Craig and Lauren to just have a preliminary discussion to take the next steps to get ready, so that when you do decide to pull the trigger, you're ready from a leverage the mortgage perspective. So we're going to really just go through a couple of questions that we've come up with from our side that between us have come from various parts of the business. So whether it's previous webinars that conversations have been, or discussions have been asked, whether it's what Craig and Lauren have experienced when dealing with the likes of SevenCapital and the common questions. So the first question that we're going to move on to from our perspective is the following. So I'm just waiting for my slide to come up. There we go. So what mortgage products are available to Africans? I suppose this is quite a general question, but I think it's important that we understand the mortgage landscape that is available to Africans, in terms of especially where we've seen a lot of deals coming out of South Africa, Ghana, Nigeria, Malawi, etc. So I think from our perspective, it's key to understand for those on the call what products are available.
Thank you, Scott. So with regard to mortgage products, there are a lot of mortgage products that are available, but the most common products are either a fixed product or a tracker product. So with the mortgage, it will be offered over a long period of time, so for example, 25 years, but the lender itself will offer a product for a certain amount of time, and that can either be a fixed product or a tracker product. So with a fixed product, it will be either a 2-year fix, 3-year fix, 5-year fix, and that means that the rate is fixed in for that period of time. So even if the interest rates change, if Bank of England base rate changes, you know that your rate is not going to change for that period of time. And with a tracker product, that means that your rate is going to track the Bank of England base rate. So at the moment, Bank of England base rate is really low, so it's 0.1% at the moment. So if Bank of England did change their base rate, then the tracker rate would move up or down in line with that rate. So that will be for example, if it was a 3-year tracker, that tracker product would apply for that 3 years. After the product period, you're then not tied in, so you can look to do whatever you want with the mortgage. So although the mortgage term is 25 years, your product is only fixed in for the product period, so 2 years, 5 years, for example. And after that time, it's up to you what you want to do with your mortgage. So you can fix it in again for another 2 years or 5 years. You can look to release some more equity if your property has gone up in value, or you can sell the property, anything really after that product ends. So you know you've got the mortgage for a long period of time, but you're only tied in for a short amount of time. And then it's kind of up to you what you want to do with the mortgage.
So Lauren, just in terms of from our perspective, if you're a new investor or wanting to find out more about these sort of things, what in your experience, I suppose the pros and cons to the product of a fixed rate mortgage? Typically, my understanding, and correct me if I'm wrong here, is that when you do a fixed rate mortgage, you might have a slightly higher percentage than the existing prime lending rate, as an example, but that's obviously, it might be arguably 0.5% more or something like that. Is that typically the case that you see?
Exactly. So with a fixed rate, the rates usually are slightly higher because the lender is guaranteeing you that rate for that period of time. So the rate might be slightly higher. Also, a 2-year fix is usually slightly cheaper than a 5-year fix, because at over 5 years, you're going to guarantee your product for a full 5 years. So the lender has to increase the rate slightly just to offset their risk. The benefits of a tracker rate is that the rate's usually slightly lower. Of course, the risk with that is if Bank of England base rate does go up, then your rate is also going to go up in line with that. With a fixed rate, the main benefit, of course, is you can plan your budget for the next 2 or 5 years, so you know exactly what your mortgage payment is going to be for that full amount of time. If rates do change, your monthly payment is not going to change for that 2 or 5 year fixed period.
Yeah, now, I think that's very sound advice, because I think that depending on your appetite for risk, you might say, okay, well, I don't mind paying a little bit more to have a fixed rate, knowing that because it's my first or second investment, I want just to have a sort of as standard as the structure can be for that period. So I know what my rental income is going to be if I've got an established rental income, and I know what my mortgage payments are, etc., so that you don't have too many fluctuations or volatility if the interest rates do increase. Obviously, there's it could go the other way, which can have an impact. But as you say, you don't want to put it out too far, because you want to be able to claw it back and make another decision again. So you might go for 3 years and then decide to do it again. I mean, is that allowed, or is that on the table? So
Exactly,
so I
yeah.
can, yeah, okay, just checking. Okay, that's great. And then on to our next question, where we will discuss really the minimum loan sizes available. I mean, it sounds, from my perspective, when we've listened to some of the questions that came of us, you know, one or two of our clients might have said, well, you know, what's the maximum I can get? And obviously, you know, the short answer to that would be, well, that just depends on what you qualify for. Traditionally, just you know, from that perspective, but certainly for somebody that's starting out and wanting to start a portfolio that's only got a certain amount of deposit, etc., what are the minimum loan sizes we are seeing coming out of Africa in terms of values and loan to values?
So the minimum loan size varies drastically from lender to lender. So each lender will have their own personal criteria, which the applicants will need to meet in order to be eligible for their products. One of the minimum loan size is one of those points of criteria. So the majority lenders, and a general rule of thumb is that the minimum loan size is approximately £100,000. Lenders like to see, let's say, at least 100,000 to be eligible for those cheaper products. If the loan size is lower, then what you will see is that there are a few more lenders which would consider sort of as low as 50,000 as such. However, you'd be capped at around 50% loan to value. So again, just to reiterate, so £100,000 minimum loan size for 75% loan to value, and if you're lower than £100,000 minimum loan, then you would be looking at a lower loan to value of around 50%. There is a few lenders which have a larger minimum loan size than the 100,000. I believe it's around 200,000, which is the minimum for those particular lenders. But as a general rule of thumb is that lenders it's around £100,000 minimum loan.
So what I'm hearing, just to be clear, is that the sort of standardized normal products are in and around 100,000 minimum loan requirement. And depending which country you're coming in from, for example, out of Africa, whether it's Nigeria, Zimbabwe, or South Africa, will determine your loan to value, whether it's a 50 or a 75% as an example. So that can often determine your price that you're going to come in at, isn't it?
Yeah, so it all depends on your personal criteria meeting the lender's criteria. So sort of 75% loan to value, looking at £100,000. But again, that will depend on your residency, income, etc., just to make sure that you do meet that lender criteria.
Okay. All right, so we'll move on to our next question. So we were talking about fixed and tracker rates earlier in terms of different products. What are we seeing in terms of rates, as an example, across the different jurisdictions that we sort of play in? You know, are we seeing a better rate, arguably, for South Africa versus Zimbabwe, Nigeria? What are you seeing and in common trends within that space?
Yeah, that is right. So the rates and the loan to value available to the client is really dependent on their circumstances. So as you say, South Africa, lenders do like lending to South African applicants because it's more of a low risk compared to, for example, someone in Zimbabwe or Nigeria. So the rates and the loan to values available will depend on location as well as personal circumstances such as income, employed, self-employed, whether they own any other properties and things like that. So generally, maximum loan to value is around 75%. That would be available to clients in a more low risk jurisdiction with income, employed income around 50,000, for example. And the rates for 75% are around 3.75 to 4.5%. With the more high-risk jurisdictions, there are still a lot of lenders available, but they will cap their loan to value just to offset their risk. So generally, the loan to value will be around anywhere between 50% to 65%, and their rates are going to be slightly higher, around 5% to 5.5%. But it really comes down to client circumstances as to which lenders we can go with and which rates will be applicable.
Yeah, and I think the important thing to realize here is that's the benefit of having a discussion with the likes of Carrick Property and Craig from SevenCapital and yourselves, is to understand the whole landscape as to, you know, depending where you're coming from and depending what your personal circumstances will determine a different rate and a different loan to value. So typically we can generalize and say, okay, well, you know, if you're from South Africa, you might get a 60 to 75% depending on your circumstances, and you could get as low as 3 to 4%. But again, it could be that the banks or the mortgage lenders view you differently, and you could be a higher risk to them for various reasons, and therefore they might charge a different interest rate or a different loan to value. So again, I think it's vital that we, you know, whilst we can generalize coming out of where these come from, I think that the point of where I'm going to is that you need to have these discussions to understand what your personal landscape ties into your objectives and what you can achieve from that. Thanks, Lauren. That's great. And then moving on to our next question, which is probably more aimed at Craig than anyone else on the panel at the moment, although Lauren and Stephen, you're welcome to have a crack at it. But I'll let Craig answer it, and then you can add some anything that you might feel relevant. But Craig, I mean, typically, you know, there's a lot of property for sale within the UK, and I think that, you know, in line with what Carrick Property, sort of the due diligence side of things and the investment committee, we make sure that we partner with the right partners in terms of like the likes of SevenCapital, etc. And when we look at the different jurisdictions, you know, you can say, well, why Manchester, why Liverpool, why Hayes, why Birmingham, you know, why London? This sort of segues typically into a question that you say, well, you know, what's a one bedroom going to buy me in London in the main sort of zone 1 versus something that might be in Birmingham? So price ranges across the UK at the moment, what are you seeing in terms of what you're going to get for your money, and where's good places to go?
Yeah, absolutely, Scott. So I think just to kind of build on what you were saying, so just from a SevenCapital perspective, we, as you guys know, we focus only on really high demand areas where we can see a clear outline of regeneration taking place, council money being spent, government money being spent in terms of infrastructure upgrades, the likes of Crossrail. And those are the sectors or the spaces rather than regions that we focus on. Going into the price points, just breaking it down a little bit. So if you look at the commuter belt around London, very important region and node, Crossrail system, close to £20 billion worth of infrastructure money being spent. That's a clear indication that there's massive growth potentially on the horizon from an investor's perspective. Looking at the likes of Slough, 18 minutes outside of London, prices for one bed starting at around 324,000 for a large apartment, one bed, up to 300,000, 400,000, 500,000 pounds in terms of different configurations, a 2 or 3 bedroom. That's 18 minutes outside of London on the Crossrail line. So you've got that connectivity to London and to Heathrow. Bracknell further down to the west of London, heart of the Silicon Valley, prices ranging from around 300,000 pounds for a one bed up to about 350,000, 400,000 pounds for two beds. Very similar to Slough, you can clearly see the outline and the regeneration taking place. Moving further up north, East Midlands, on the horizon, stock coming through studios 1, 2 and 3 beds. Prices ranging from 125,000 to 170,000 for a studio. And at that price point, just to point out and build on what Lauren and Craig were saying, there are lenders with the minimum loan size of £100,000, 75% loan to value that would fit into that product, into that stock price. So there definitely is mortgage opportunities at those, call them entry level price points with studios. One beds in the East Midlands, 155 to 200,000 pounds. Two beds, 200,000 pounds to about 240,000 pounds. And 3 beds in the East Midlands from 260 up to about 300,000 pounds. So you can see in comparison to the rest of the UK, these are high demand areas, lots of regeneration taking place. And for a new build, the price points are coming in really, really well. So you should, on a new build, see really good valuations coming through from the lenders. And based on the entry price point of a long-term investment period, you should see really good cap appreciation and demand as well. The West Midlands, just as a comparison, likes of Birmingham as an example, massive regeneration taking place in Birmingham. One beds from 275 to 300,000 pounds, 2 beds 310 to 335, and 3 beds from 380 to 400,000 pounds. And these are really high-end, really sought-after developments, very modern. larger part.
So just understanding the price ranges across the different regions. I mean, typically, if we've got a property in at 120,000 that's coming in,
yeah,
my understanding that's really going to fall potentially, especially from our clientele within the Africa region. It's going to be a bit of a struggle to get a loan from that perspective, and it's going to really fall more into a kind of a cash product, potentially at around the 120,000, just purely because of the minimum requirements from the vendors in terms of mortgage requirements, in the minimum requirements. And so there, typically, we would probably look at sort of your studio one bedrooms coming into some of the areas you mentioned, around 170,000 to make it work. Is that right?
Correct. So not to steal your thunder down the line, but Visionary Finance, of course, are able to do a fact find for the clients, as Lauren pointed out, I think, and that could almost preempt or predetermine what sort of price points we're looking at for that specific client. Knowing exactly what we're going in for, it'll narrow down the search in terms of the right investment for that client.
Yeah, I think from our perspective, it's certainly, and we will talk a little bit about the end around next steps and how to proceed from here without you stealing my thunder down the line. It's fine, great, thanks. All right, so let's move on to the next question. In terms of the maximum borrowing available for buying a buy-to-let property in the UK, I think we kind of touched on that one in an earlier conversation. I mean, if a client's got an appetite for £1 million, from your perspective and experience, Craig and Lauren, what are you seeing in terms of the rates that they're achieving and the criteria? What is the typical mortgage that they might look at? Would they look at interest, or they look at interest and capital? What do you generally see at that price point?
So for the higher loan amounts, it really doesn't really change. When you're at the higher end of the spectrum, it's still same policy, same criteria, as long as the client can meet the deposit. So whether it's 25% or 35% deposit, there are lenders out there who really, there's no really maximum, as long as the client can, as I said, meet the deposit and meet the lender criteria, then generally the same rates will apply. If it is very high borrowing, the lender might tailor the product itself to the client. But generally, the same rates and same criteria will apply at the higher end.
So interest rates, even though you're essentially borrowing more, you're still going to pay a very similar rate. I mean, are you finding investment at that price point?
Yes, the rates might even be cheaper where the borrowing is higher. Some lenders will scale their products and offer a more competitive product for a higher borrowing amount.
And just as a matter of interest from my side, are you seeing them have do any of them take fixed rates at that point, or do they stick to a tracker product more? What are you seeing from that perspective?
It's the same really, either fixed rate or tracker rate. It might be that a fixed rate is needed depending on what the rental income is, and the way that the lender will work out the maximum borrowing usually will be based on the rental income from the property. And there's a more flexible approach where there's a 5-year fixed product as opposed to a tracker or a 2-year fixed. So it might be that a 5-year fix will give a more maximise the borrowing capacity, but the other products are still available regardless of the loan amount.
So just a quick reminder for all of our webinar people that are on this call. You're welcome to ask any questions, put them into the chat room. We're very lucky to have the likes of Craig and Lauren here. So if you've got any questions that you want to give us, please put it into the chat room, and I'll certainly position them with Craig and Lauren. And if you've got any questions around developments of products, etc., please put them in the mix and I'll ask Craig Warwick from SevenCapital as well. And just in case there's a few that might struggle a little bit with understanding Craig and Lauren from the English accent, or my South African accent for that matter, this will be recorded and you will be able to play it back, and we will be sending you a recording, so don't worry there in case you missed a question or you'd just like to go back and look at something. This will be recorded for your purposes, so don't worry about that. please be welcome to throw some questions at us if you've got any, while we've got this panel of experts alongside me. So thank you. Okay. Next question, I think, was really about, we spoke about the fixed and the tracker components of a mortgage product, but something that certainly South Africans and the likes of some of the African regions may or may not be familiar with, depending on how far you are in your real estate journey, what is an interest-only basis loan versus a capital and an interest rate, and really what are the pros and cons to it? I know that's quite a long, loaded question, but I think it's important for our viewers to understand, the impact of, okay, well, in some of our cash flow illustrations or our investment summaries, we'll position a principle around the interest-only mortgage, and that would be for a period of 5 years, as an example. Do you want to take us through that, Craig or Lauren, this question, and sort of, we can expand if necessary?
Yeah, of course. So first of all, we'll just break down what the differences are between the interest only and the capital and interest payment basis. So capital and interest is whereby you will be paying exactly what it says on the tin, both the capital and the interest. This means that your monthly payments will be higher, of course, as you're paying both. And that allows or guarantees certainty at the end of the mortgage term that the whole entire mortgage loan amount will be repaid in full. Whereas interest only, again, is exactly what it says on the tin. You will just be paying the interest only element of the loan which you borrowed from the lender, which means that your monthly payments will be lower because, of course, you're not paying the capital element. But as a result, the loan balance will remain the same throughout the term. So at the end of the term, there's still that outstanding loan, which you still technically owe the lender. So the sort of pros and cons of both, of course, with the interest only, which tends to be the most popular when it comes to buy-to-let investors. And the reason for that is increased cash flow. If you're receiving a rental of £1,000 a month and your interest only payment is only £300 a month, of course, then you're just gaining additional in terms of which is coming into your bank every month. Whereas if it was capital and interest, your monthly mortgage payment will be a lot higher than the £300 a month, for instance, which means, of course, there's less cash flow. Obviously, that cash flow is down to yourself, what you obviously wish to do with it, whether that's looking to other investments perhaps, or put towards savings for another deposit for another property. So that is the main reason why the majority of buy-to-let investors go for that route, down the interest-only route in the UK. Whereas the drawbacks of that is the fact that the loan amount remains the same throughout the entire mortgage term. So at the end of it, it's still got that essentially bullet payment at the end, which is repaying the loan. So the lender, of course, will expect to be repaid at the end of the term. And again, there are many sort of routes you can go down in terms of this. Probably the most common is perhaps obviously from savings or sale of the property as a repayment strategy, as lenders will require what's referred to as a repayment vehicle, just to make sure that they're comfortable that at the end of the term, they're going to get their money back as a result of obviously lending this out.
Okay. So, I mean, it just depends on what your strategy is in terms of and how you want to gear. So whether you're building a portfolio or as you alluded to, is how much capital growth would be in that and how much positive cash flow, etc., would determine potentially the way forward in terms of whether you take an interest only and pay it off at the end, or go into something where you think, okay, well, I'm going to take my positive cash flow and put it into the capital and the interest basis loan as well.
Yeah, absolutely correct.
Craig, anything, Warwick, from your side that you'd like to add while we're talking about this? What are you seeing as a common trend?
Yeah, I think so. Just looking at and going back to the regions that we looked at, the price points, etc., and the regeneration elements of those territories. To build on what Craig said, in the interest-only space, what we do see in the right region with the right product in terms of the right development, the capital appreciation, which yes can slide either way, is anyone's guess, but what you do normally see over a kind of 10 to a 15-year cycle in the right areas is the property values essentially double. So what you do find in the longer term mortgage space is after that period of time, you're sitting with an appreciated asset, you've been cash positive, as Craig said from the start. So you are in a position to either use that equity down the line and leverage it, or obviously sell the property and you're still walking away with a positive lump sum and the growth at the end of the day, if you do hold on to it for a set period of time.
Okay. So we've got some nice questions coming through, which I'm going to kind of leave to the end for us to discuss, because there might be a little bit of overlap before we go into our Q&A, but I'm seeing that we've got some nice questions coming through. So for those of you that have sent your questions through, we will be answering them shortly, and thank you, keep them coming, because I think there's some great questions there that we can certainly put, not just to me, but to the panel, and get a kind of, without throwing anyone under the bus, because there's one question here that's certainly going to keep us on our toes, but I think it's a great question in the current market. Okay, so I think from my perspective, just moving on to understanding how long this all takes. You know, we mentioned this 6 to 12 weeks in a perfect 6 weeks perfectly, and 12 weeks at the maximum probably. I mean, in terms of the mortgage process and the different steps from handing in to, you know, and I think preparing your documentation, etc. Lauren and Craig, what's your take on things?
Yeah, so the 6 to 12 weeks, as we've mentioned before, is kind of a standard time frame. It can range anywhere between that time. What the more accurate timescale comes down to is which lender we can go with based on the client's circumstances. Some lenders have much quicker timescales than others, and some lenders will have a lengthier process if it's a high risk application. It really comes down to how quickly as well we receive documents back from the applicant. So during the application process, the lender will request information and documents, perhaps depending on what their process is and what clients' circumstances require documents-wise. So when we request those from the applicant, sometimes it can take some time to gather those documents. So that's sometimes where a delay in timescales can be. But we of course do everything from our side to make sure that it's gone through the process as quickly as possible and avoid any delays.
Okay. Okay, great. So I think, you know, like anything that when you're trying to apply for a loan of any kind, it's a two-way street. You know, without the information required, it's going to delay the process. So I think it's important, again, when we go down a fact finding and a small 15-minute interview with the likes of yourselves, it's important just to do that up front so that you can almost be ready when you are ready, as I said earlier, to pull the trigger and say, okay, I found the product I want, I have my documents in order, let's go. You know, especially it depends on your strategy. So if you're looking at something that's off plan or that's going to be completed in 2 years versus something that might be ready in 3 or 4 months time, or even ready now. So it really just depends on your ability to pull that all together and make sure it's ready, so that when you are wanting to pull the trigger on it, you've got all that documentation in place. Okay, so I think we're moving on to the tail end of our frequently asked questions, and kind of mentioned this in terms of typical documents required that we need to do. So I mean, like I suppose anything it's really, if you're doing it on a personal basis, it's going to be the things like bank accounts, etc., payslips. Is that along those lines?
Yeah, absolutely correct. We don't request above and beyond as part of our process. As mentioned earlier, we try and make it as simple as possible. So we're not going to be requesting mountains of documents. We try and limit it as much as possible based on the information that we need in order to make educated research to sort of tailor the product to our clients. So the information which we will need following our sort of initial discussion, and we'll always send a list just so you don't have to remember this, of course, is a fact find. That is just a form which will need to be filled out by yourself, and that will encapsulate all of the information that we require from you. That will allow us to gather a full understanding of your circumstances and allow us to find out the information which we wouldn't initially be able to do so over the phone, which will then allow us to provide you with the cheapest rates available to yourselves. On top of that, it's very standard documentation which is requested not just by us but by the lender when we submit the application. So it's going to be ID, proof of address, bank statements, usually 3 months. Some lenders can request 6 months, and then income verification which can either be usually 3 months pay slips if you're employed, or 2 years tax returns or other income verification if you're self-employed. And that's generally what we require at the initial stage. Once we've submitted your application, we are at the hands and the mercy of the underwriter as to what they request. We'll always try and limit the amount of requests which we make from you by uploading as much documentation as possible at the initial stages, and also taking out some of those requests by answering based on the information which we know from the original fact find.
Okay. So I think, again, just to reiterate that you know, a short conversation with yourselves and a fact finding, well, certainly what we commonly known as a approval in principle would, you know, just to get, as we said, talking about getting ready and having that stuff, you know, that will give you an indication of what you can buy with reference to that, and just having that paperwork in order from that perspective. Okay, and then we're nearly finishing up on the questions, if I recall correctly. Just have a look here quickly. Just checking to see. Okay, so from our perspective, in terms of preparing for a mortgage application, I mean, you know, we've alluded to it and we've touched on it in terms of, well, what do we, you know, what's the best way to go about it, Craig and Lauren? I mean, so that we can make sure that we can go ahead.
So first thing I always make sure the clients are aware of is to open a UK bank account. Sometimes a client wants to start a mortgage application, but they haven't yet opened the UK bank account, and some lenders need that account open before we could even apply. So if you are seriously looking to invest and you are wanting to prepare as best as you can, it's always best to get the UK bank account open, because that can sometimes take a few weeks for the lender to open up the bank account. So banks that you could use, for example, HSBC, a lot of clients open a bank account with them, or other mainstream lenders such as Barclays, Lloyds, for example. There are a few other smaller banks or providers that you can use if you struggle to open up a bank account with one of those big banks, for example, Monzo or Starling or Wise, which is accepted by lenders for the UK bank account side of things. The other thing we would say is to arrange the initial consultation, because that really will give you a clear idea of what your options are. So from a 10-15 minute conversation with us, we can narrow down what your options are so that you can make sure the properties you're looking at are within your price range, and also know what kind of rates to expect based on your circumstances. So yeah, just a quick telephone call to run through your circumstances and mortgage requirements. We can give you a clear idea of what kind of properties you should be looking at.
Okay, so yeah, I mean, Craig, Warwick, in terms of our clients on this side, typically, what are we doing to support them to opening bank accounts? Or is that something that we are facilitating with? I'm just putting that question to you.
Yeah, not necessarily from our side. I have found, for the most part, most of our clients looking to invest in the UK do have those structures in place.
Yeah.
But where not, as Lauren said, there are some smaller banks, if they do struggle with the larger banks in the UK, as well as some local banks in SA, for example, with reach and positioning in the UK themselves. The likes of Investex, etc. So yeah, there's opportunity there.
Yeah, and I think that's certainly something to consider, even though we are on the call with Visionary Finances, is just certainly to look at how your bank can help you from an external offshore perspective as well. Certainly we're talking to your private bank, etc., if you have one around those options as well. Okay, so I think that's quite key in terms of having that conversation with the likes of Craig and Lauren and going into that. So we're going to go into Q&A. So we're going to probably have about another 5 minutes, and then that should call it for a day. Craig, this is probably more aimed at you and me than Lauren and Craig, but are there any positive cash flow properties in the market from your experience? So I think that's for us quite a nice question to answer, because in reality we won't really touch anything that doesn't have a positive cash flow. So from our perspective, I mean, typically depends, and I'm just sort of shooting the breeze with you here, but I mean, typically our cash flows, you know, it depends on how you view it. So if you are going to leverage and you look at return on your equity over a 5, 10 or 15-year period. Over a 5-year period, your in terms of return on your equity would be probably in the region from 50 to 70% over a 5-year period, depending on the type of investment you're in. But certainly from a cash flow summary perspective, would be about, well, are you buying a 150,000 pound property or a 300,000 property, which determines your rental income, as an example, that and then obviously determines the size of your mortgage. So, but we typically won't really go touch much under, particular yields on average are around 5% gross yields, 4% net. So you generally come out with a very good positive cash flow from our perspective. Craig, would you agree with that sentiment?
Yeah, I think to add to that, there's quite a few layers or elements in looking at a cash positive investment. And in the UK specifically, not to backtrack, but again, going into the right area at the right time, making sure that there's regeneration, making sure that there's peak demand, high occupancy rates. Those are all going to feed into the positive investment case at the end of the day, as well as obviously the deal structuring from the lenders through Lauren and Craig. That speaks into the net effect at the end of the day as well. So I think when you look at all of those components, and we make sure that it's the right opportunity and investment for that specific client, it will be a cash positive from day one. Yeah.
Right. Yeah. So for just reaching out to the person that asked that question, you're welcome to give us a shout and we can discuss and take you through an investment summary example for you. No problem around some typical examples we have to give you. And then there's another one for us in terms of typical upfront costs for purchasing a property in the UK, Craig. What are the typical upfront costs from our perspective?
Upfront, if you're looking at a off-plan development or in the off-plan space, which 9 times out of 10 you would be, you're looking at around £2,500 as a reservation fee to secure the apartment. You then go through the exchange period of 28 days. The solicitors assist you, etc., etc. Those fees come in around £1,500. The £2,500 reservation fee comes off the purchase price. And then if you're doing a mortgage through or going for a mortgage through Craig and Lauren at Visionary, they can give you the costs for that. But typically, I mean, Lauren, if you can maybe touch on that, the mortgage origination fees.
Yeah, so we charge 1% fee for overseas clients, and that is capped at 2,500. There might also be associated fees with the lender's product, and that does vary between lenders, but a lot of lenders, some lenders do allow you to add that to the loan. Yeah, yeah.
So Scott, just to backtrack a little bit and pull it all together, in the off-plan space, the immediate costs for the client to reserve an apartment and get on the ladder, it's the £2,500 reservation fee. You exchange contracts a month later. You then pay a 20% deposit minus the 2.5 already paid, and obviously then the solicitors' fees and Visionary Finance fees. And then you wait until completion.
Coming towards completion, we've got the equivalent of stamp duty, which gets added on top of that, which is if you're straight viewed as an out-and-out right foreigner, it's around 6%, depending on the 4% plus the 2% surcharge, if we can call it that, depending on your structure and what price you're coming in at.
Yeah, correct.
Okay. Yeah, so just again, just to reach out for those that asked the question, we have got those costs in more detail, and we can certainly send that information on to you from that perspective. I'm going to throw one at Craig and Lauren. We've got a couple of more questions, and then we'll finish up. Is the potential rental income not more important in determining the level of debt or bond finance rather than a South African and based salary slip? So I'll just repeat that question. In terms of the potential rental income, not more important in determining the level of debt or bond finance rather than a South African rand-based salary slip. So I think what.
Rather than what? Sorry.
Than a South African rand-based salary slip. So how do the banks view, for example, the fact that you're going to be earning a rental income in that local pound currency versus a salary slip in South African context?
So the rental income is usually what's used to work out what the maximum loan amount is available to clients. Lenders use what's referred to as a rental stress test. And essentially what they want to make sure is that the rental income received from the property is enough to cover the monthly mortgage payment and then some. The reason why the, for instance, South African rand or the local currency or employed or self-employed income is taken into consideration is because should there be any rental voids or any tenants whereby you're not receiving any rental income from the property, the lender wants to be comfortable and satisfied that should you not be receiving rental income for those periods, you will have enough money to essentially satisfy and to make the monthly mortgage payments. So that's why certain lenders have a minimum income. Although this doesn't actually work out what the maximum loan amount is available to yourselves, you will need to meet this minimum income in order to be eligible for their mortgage products by meeting their criteria. But ultimately, it will be the rental income which determines the maximum loan amount available using that rental stress test.
And also with the minimum income, just to give you an idea of what kind of income a lender will look for, it usually ranges between the equivalent of £25,000 to £50,000. So as long as you can meet that threshold, the lender will then look at the rental income to work out the maximum borrowing.
Okay. I know that in South Africa, as an example, sometimes they'll look at if you're buying not a second property or third property, whatever it is, they'll probably take into account, depending on circumstance, 25 to 50% of the value of that rental income, as an example. So it's slightly different within the UK from that perspective too. And then Craig, one that's probably aimed at us, there's been a surge in the house prices due to the attractive interest rates available currently. And so from our perspective, what do we view as the peak of the property market? Is there still room for the prices to move up? Which is a difficult question to answer, and I said that's going to keep us on our toes. But I think, I don't know if you want to have a crack at it, and Craig and Lauren, you're welcome to put your view on this from a UK experience perspective.
Yeah, I mean, from the developer's side, I think it all boils down to that key element in our kind of core strategy as a developer is making sure you've got the right product in the right market in the UK at the right time. You will see that appreciation. You will see price houses rise where there's an undersupply of stock, of prime stock, feeding into a market that's growing. And I think that's a key component for the investor base to look at, to make sure what's going on around this development, what's going on in this town, in this region. Why is there an undersupply, and where does that peak? And am I getting it in early enough to see as much of that cap appreciation and growth over time?
Yeah. I mean, if we look at typically, in terms of some of the research and some of the reports that have come out where we've seen over the last period of 12 months, in the last 12 months is around 8.8%, if I recall my numbers correctly, in terms of growth within the UK market. And I think that, that's on a national level, and we obviously go and look at where as you say, those jurisdictions, when we run them through and we do our numbers, we make sure that there's a good growth potential. Obviously, like anything, there's no guarantees, but certainly it's important for us to negate as much as risk as possible when it comes to that aspect. So, in short, I think that to answer your question directly, we have no control of what the market's going to do in the future, but we certainly in the jurisdictions that we get involved in, we certainly will look at positive capital growth area, and certainly some of the predictions. Certainly, for example, the London commuter belt over a 5-year period is just under 20%. Some of the stats that are quoted, and then you look at some of the, and Craig, you'll know this from, I think, some of the stats in the research you did. There's a 2036, there's a 40,000 home demand, which equates to about 35% of that being in the apartment type aspect as well. So there certainly is a lot of potential for growth, but again, with the likes of impact of COVID, etc., we can't predict what might come out from that perspective. Okay, so I think from our perspective, what we'll do is, if there are any questions we've missed, we will come back to you directly. I'm conscious of the time, and we're coming up with just under an hour. I hope you found this beneficial, and really from a call to action and next steps from our perspective is get in touch with the wealth advisor or myself. My details are below, and we will certainly, if you would like to take your next step in finding out more information, we'll put you in touch with Craig and Lauren and do a fact finding and some products within Craig Warwick from SevenCapital as an example. So please get in touch with us. I think it's important for you to understand, if you are interested in property offshore, have a discussion with myself, and then we can put you in touch with Visionary Finance, and they can take you through, and we'll look at products with Craig as well. Thank you very much for joining us from wherever you are. Thank you to Craig and Lauren. Thank you for your time today. Much appreciated.
Thank you.
And Craig, Warwick from SevenCapital, thank you for your time. And that's it from us. And get in touch with us if you've got any more questions. Have a good day. Thank you.